Welcome to our YouTube live, and I'm going to be talking about what the Bank of England did today, which is to do nothing. And I think it's a bit more interesting than that because the reasons behind what they did is always the interesting part of one of these decisions. And I think it's a very different story from the Federal Reserve, which is what we talked about yesterday on another live stream. So let's just go through exactly what happened. I think the big difference between the US and the UK is in the US, growth is much stronger than expected. People were expecting a recession this year. That's far from the truth. We're getting pretty strong growth in the US, surprisingly strong enough to be a problem and to be inflationary. Whereas in the UK, we've got almost zero growth for the foreseeable future, certainly for the next 2 years, 3 years, for the outlook period from the Bank of England. So from their point of view, the economy is much more fragile in the UK than it is in the US. So I think the other problem is that if the Bank of England does have a really restrictive monetary policy, there's always the risk that it could crush any kind of recovery. And that's a big concern for the Bank of England. And at the same time, it's got very sticky inflation for various specific reasons for the UK. However, there are certain positives, and we'll go through those during the course of this chat. And I think the major one is to do with energy, as we'll see. But that was more due to luck than the skill of the Bank of England, I have to say. So here's the vote. The vote was 6-3 to maintain bank rate. And the dissenters wanted to raise bank rate by 0.25%. So it wasn't unanimous, and if anything, people were asking for rates to be increased from where they are now. So a very different story from the Federal Reserve, where they'd pretty much reached the end of the cycle. That was clear yesterday, and now they're starting to talk about cutting rates. But they've got much further ahead when it comes to cutting inflation, and that's the reason why. If this is from the November, this tweet is from the November Monetary Policy Report, just to show you the history of the bank rate, which is now at 5.25%. It's still at 5.25, of course. But just to show you the rate of increase is just pretty incredible. And if we look back over 400 years, this is how long we've got data for the Bank of England. I always make the point that this is just going back to normal. So 5.25% is actually the median rate going back to 1900. But also going back to 1700. So don't be shocked by 5% rates because this is actually quite normal. We're just used to zero because of a very odd period in history after the financial crisis. But these are the aggressive rate hikes which we saw, very aggressive for the Bank of England, with one of them being a 0.75% increase. And you can see we've been flat at the top here for a while now, and we're probably going to be flat at the top or increasing slightly for some time to come. So the real problem, of course, in the UK is inflation's proved to be very sticky indeed, more so than in other developed markets in some cases. And if we look at the actual two components that people usually break it down into, core inflation strips out volatile components. This is food, alcoholic beverages and tobacco. Those are very volatile price components and they make the price flop around a lot more. So the Bank of England, of course, wants to look through these fluctuations, so they choose this core measure to look at. So that's in yellow. And you can see that that has been falling fairly consistently. So 1, 2, 3, 4, 5 months of successive falls in core inflation, which is really reassuring to see. Headline inflation, on the other hand, is plummeting. And that's largely a story to do with energy, as we'll see. But that's currently 4.6%. The other benefit of that, of course, is that real wage growth is now what we see. Wage growth is higher than that 4.6 rate of inflation. So that's great news because it means that your wage, on average, in the UK is going to pay for your groceries and your living costs and then some. So you're going to see effectively an increase in the quality of living, which hasn't been the case for a long time in the UK. If we break it down by components, you can see that there's one component year on year for the CPI 12-month rate, which is negative, and that's housing and household services. If you break that down again, you can see that that's due to energy costs falling. But almost every other component is positive. Food and non-alcoholic beverages still very high. Restaurants and hotels still pretty high. So is recreation and culture. If we look at the 1 month change and break it down by contributions, this is between September and October of this year, that's the latest data we've got on inflation, you can see that almost all of the components are close to zero contribution, except for one huge one, which is this housing and household services, which is due to that energy price fall. And if we compare us internationally with other developed markets, you can see that we are still pretty much at the top of the pack. We're below the EU average now, which is 4.9% inflation, and we're above France, Germany, and of course way above the US at the moment. But it is reassuring to see us, it was just a story of delay, our inflation coming down relative to others. Perhaps that's the way we fix prices for energy using the price cap, and that was what delayed the fall, which was in other countries also due to energy prices falling. So perhaps that's one of the reasons. Another reason might be Brexit, that is inflationary, and that has pushed up food prices and the prices of other imports from Europe, probably. So now let's take a look at the press conference, which was held today by Governor Bailey. Oh no, there wasn't one. I'm just making a point here. I think there should be one, because if they don't have one, it just leaves people hanging. And I think it's as a really important part of the Bank of England's job is to explain what they're doing in really simple terms, because monetary policy is only effective if the populace understands what on earth you're doing. And all people feel, I think, is a sense of betrayal, because they see their mortgage rates go up, they see the cost of living increasing, they don't really understand what's going on. And the Bank of England's missing an opportunity here, because they are the good guys. They're the ones that are trying to stop this happening. And yet they're stepping back and saying, no, we're not going to do a press conference because we haven't published a monetary policy report. You just get the sense that they're so out of touch with their role, which I think should be to talk to people and explain what they're doing. And I think monetary policy would be more effective if they told people what they're doing and explained it better. They try, to be fair, but I think they could try harder. And I think that their attitude, potentially at the top of the Bank of England, shows that they're not really dedicated to doing that. Also, their website doesn't work, which I think is also another sign that institutionally they are just not putting enough effort into communicating with the public. But look, that's just my tuppenny's worth. So let's have a look at the good news. The good news came from something which has absolutely nothing to do with the Bank of England. And if you're not used to seeing this number, this is the price of Brent crude in dollars per barrel. And we have seen that fall pretty sharply over the last few months. And of course, it's way off the peaks that we saw back in April of 2022. And of course, that's going to be disinflationary. That's going to push down inflation, particularly as we're a big energy importer. So if you break down the UK, roughly, we import oil and gas and we export services. That's what we do. So gas and energy are a cost, services are a revenue generator, but if the energy prices go up, we're kind of stuffed, because that increases our costs and is a drag on the economy. So the fact this has come down is great news. So let's just hope that energy prices stay low, despite the fact that OPEC Plus wants to increase that to about $100 a barrel. But so far, by restricting supply, they haven't been able to engineer that yet. So let's hope they don't manage to engineer that, because it's going to be bad news for us. And the Bank of England acknowledges this. If you look at their monetary policy statement, which they did bother to make, they say that the decline in CPI inflation over recent months could largely be attributed to falls in energy, food and core goods price inflation. And actually energy is the biggie. As external cost pressures had continued to abate, service price inflation, as we'll see in a moment, had remained elevated, however. So, they see that, okay, they were lucky. It had nothing to do with monetary policy. It had nothing to do with fiscal policy from the government. But hey, you've got to take these breaks. So this is from the monetary policy report when they did make one, when it was last published, which was in November. I just put this here so that you can see what I was saying about GDP. The forecast for GDP was 0.6% for this year, essentially zero growth next year, a tiny bit of positive growth in 2025, and then back to 1.1%, which is still pretty feeble in 26. So pretty weak growth. The numbers in parentheses, by the way, are from the previous report in August. So those were all downgraded as a result of weak growth outturns. Now inflation, they think, will come back much closer to their target by the end of next year. So that's the hope of the Bank of England right now, that they'll get inflation back pretty much under control by the end of 2025, Q4. And as a result of that, that means that the bank rate's going to fall from 5.3% down to about 4.5 in 2025 and 4.2 in 2026. So not a huge fall in that at all, but certainly below where we are right now, which is 5.25. And this is the projection for GDP, pretty much flat. This is the projection for CPI inflation based on market implied interest rate expectations. So this is what the market thinks is going to happen to interest rates. And this is based on keeping rates at 5.25 forever, effectively, all the way to 2026. And there isn't a huge difference between them. And it's going to take a long time to squeeze inflation out of the system. At least that's what the Bank of England's model is telling it right now. If we look at wage growth in the UK, remember that services inflation was very sticky. A lot of that is driven by rapid wage growth in the UK. Now, if you look at this recently, you can see that it has fallen off these incredible peaks, almost record wage growth peaks. And this is nominal wage growth. It hasn't adjusted for inflation. Currently, it's at 6% increase year on year. Remember that inflation's 4.7, so woohoo, we've got real wage growth. That's the good news. The bad news is that that's inflationary, because if companies don't take a margin hit, they're going to have to pass that on to their in their product prices, and that could produce inflation. So that could be inflationary, and for services it's very likely to be inflationary. If we subtract inflation from that nominal wage growth, we'll get real wage growth, and it's currently positive, as you can see, 1.2%. However, we've been flirting with positive and negative wage growth for a long time in the UK, such that the level of wages right now, as of October, are pretty much where they were in 2008. So we haven't seen wage growth in the UK in real terms for about 14 years. In other words, our quality of life, our quality of living, standard of living is the word I'm looking for, that our standard of living is roughly where we were over a decade ago, 14 years ago, which isn't great. And remember, for that entire time, we've had a Conservative government who is presumably dedicated to trying to improve that, and yet they failed to do so. So clearly, high inflation is a government changer. Often what you see is that when you have a spike in inflation, people get really upset with the government, and I think this is no exception. Usually that results in a change of government, and of course that's what many people are expecting. Whether the new government can do any better remains to be seen. Personally, I doubt it, but who knows? Let's hope for the best. This is what the Bank of England was mentioning about services inflation. So if you break it down by goods and services, services makes up about 80% of the UK economy. Manufacturing makes up a smaller component, much smaller. So the fact that goods prices are falling dramatically, well, at least they're still rising year on year, 2.9%. Disinflation means the rate of growth is falling very rapidly. In contrast, services inflation is still 6.6%, very high, and not really falling much at all. Of course, because if wage growth is still high, then you wouldn't expect services prices to fall much. So services would be things like going to the restaurant, having a haircut, going to a lawyer, doctor, dentist. All those would be classed under services. And services prices, I'm sure you've felt it yourselves in your household budgets, are not falling. They're still rising pretty fast year on year. So this fundamental problem with the UK at the moment is to do with the tight labour market, and that really has started to ease now, I think. So if you look at unemployment in the UK, it is starting to rise and rise sharply. So that's gone up to 4.3%. Again, contrast this with the US, you really don't see that at all. Their jobs growth is still pretty brisk because demand is still strong. People are still shopping, people are still earning, people are still employing people to service jobs. But in the UK, we are starting to see a big softening in the labour market. Not huge, but by historical standards, of course, unemployment is still very low. But it's nothing like we saw in 2008, when unemployment increased from about just over 5% to around 8%, 3 percentage point increase. Nothing like that so far, but it is moving up rapidly. So that's definitely one to keep an eye on. And although it seems atrocious, and it is atrocious in terms of the impact on people's lives, that's probably the way to get wage inflation down, is higher unemployment. And the labour market still remains very tight. So what that actually means is if you look at the number of job vacancies per unemployed person, that remains very high compared to history. It's kind of come back to where we were just before the pandemic. Notice how even before the pandemic, that was rising very quickly. So a very tight labour market means that supply and demand in the labour market are out of balance. There's a bigger demand for people to work than there are people who can fill those roles. So that's still worrying, I think, the fact that it's falling very slowly. We've got a tight labour market, high wage growth and high inflation and sticky services inflation, which won't come down until this labour market has a bit more slack in it. And usually the way to fix that is a recession and unemployment. So perhaps it's going to be painful, I know. It's going to be a good thing to get a period of recession. Now, if we look at the number of economically active people in the UK, that's kind of stabilised, and that's a bit worrying because many people stepped back from the labour market during the pandemic and didn't return to it. Whereas in the US, we're seeing an increase in immigration and we're seeing an increase in supply of new workers, which is easing the lack of workers. In the UK, we're trying to do the opposite. We're trying to stop immigration, and presumably that's going to keep this labour market tight. And at the same time, what we're seeing is employee jobs increasing very rapidly. So that's not going to ease the tightness of the labour market. In fact, that immigration policy is probably going to make this an even tighter market, tighter labour market. So I think that's possibly going to be a problem, and it's pulling in the opposite direction to what the Bank of England is trying to do, which is to get inflation under control. Now, of course, the thing that everyone's worried about is their mortgage. That's what they really care about when it comes to the Bank of England. And if you look at mortgage rates, they are falling. However, the Bank of England thinks we're about halfway through. So 5 million people have already started to feel the pain of higher mortgage rates. But the Bank of England thinks that until 2026, another 5 million households are going to enter this painful place where they have to refinance their mortgage at much higher rates. And on average, it's going to be about 39% more expensive to service those mortgages once they come to the end of their fixed period. Now, that's not a mistake by the Bank of England, it's deliberate policy, even though it's painful, because what they're trying to do is to stop people spending, reduce demand, get inflation to come down as prices fall, and hopefully when things will return to normal, they can put rates back down to something which is closer to normal, maybe 3.5% in the UK and 2.5% in the US. So there we have it. That's it. That's my thing. And if you have any questions, please do ask them. I got through it without choking, which is good. Still got my cold. And I shall summon my dog in case you have any questions. Please do ask them. Please do like and subscribe. And don't forget, next week we've got a live stream with Damo. This is on Tuesday. And yeah, please do join us for that. It's going to be great. And I've got my Christmas shirt line. In fact, why don't I show you my Christmas shirt? Shall I show them the Christmas? No, you just want the treat, don't you? My Christmas shirt, it's absolutely horrendous. There we go. Some last 2 treats, mate. Is that good? Doesn't smell good. One more. You want one more? One more. Go on then. Yes. Good boy. So let me show you my awful shirt. I'll just get it. It's just over here. Awful shirt, Ted. Yep. There we go. Here we go. Especially from Asda. It's my Star Wars theme, yeah. And it's got Grogu. Where is he? Grogu. Can you see that? Yes. Beautiful. You see Grogu? Yeah, there he is. So yeah, I'll be wearing that with Damo, and we'll be having a Christmas special with various Christmas themed stuff. I've finished all the treats, mate. No more treats. There you go. We've topped up the biltong, so he's happy. I've got a very good biltong shop in Amersham, so that's great. Anyway, if you do have any questions, stick them onto the chat, and if you do super chat, obviously it helps us. I'd appreciate it. We'll push you to the front of the queue for the questions. And if you are one of our supporters on YouTube, also, we'll push you to the front of the queue. Let's see what we've got for questions. Oh, here we go. Simon Scott says he's opening a book on how many treats for the dog, opening at 3. Well, sadly, see, I would have gone for 3, funnily enough, Simon, but no treats left. I've got to do his next food order, which costs about 80 quid. It's amazingly expensive, this huge, it's like a 12 kilogram bag of food, but I get lots of treats for him. So you would have been spot on, Simon, but sadly, it was 2. RSB says pile into FTSE 100 funds. Trico says thanks for the recent video on bond funds. Yeah, a lot of people are asking about bond funds because people seem to understand bonds better than bond funds, which is a bit surprising, but they are more complex, bond funds, because it is a portfolio of bonds, and it's all of the mathematics that goes into bonds actually applies to bond funds as well. All the stuff about duration, total return, all of that works, except I think the complex thing is that the actual coupons of the bonds inside the fund change very slowly over time as the bond rolls its contents, and I think people have trouble getting their head around that. But anyway, that's, yeah, I'm glad you enjoyed it. Thank you, Trico. Mickey DeJosh says, hi Ramin, what ETF would be the best for a new SIP to get the best value for money now the stock market has risen? Well, there are so many to choose from. If you go for a global stock fund, I made a whole video about this, one ETF to rule them all, it was called. And really there's so much choice now, and there's so many low fee ones out there. If you've got to have an ETF, there's a very cheap one from Invesco called FWRG, for example. And if you're going for a fund, not an ETF, there's a very cheap one from HSBC, which is a FTSE All-World tracker. So there are lots to choose from. And you can make it even cheaper if you just go for developed world. And the one I've got, my global bond fund, global stock fund, is a it's one from Vanguard. The fee is 0.14. Its ticker is VHVG. VHVG. Let me just check. Yes, It's a Vanguard FTSE Developed World UCITS ETF. That's the one I've got. And the fee's 0.14. So developed market equity is usually cheaper than all world because the bid offer spreads are smaller, I suppose. So that's why the fund is cheaper. But that's another way you can make the fund cheaper. RSB says, why is 2% inflation their target? Why not 3%? No reason at all. It's just that banks generally, central banks, randomly came up with 2%, and they've all kind of gone for it. Almost all the developed market banks certainly go for 2%. Some of the banks in EM go for a higher rate, but certainly Bank of England, Bank of Japan, Bank of Canada, Bank of New Zealand, all the developed market ones, and the Fed, of course, they all go for 2%. But it is just an accident. I think that's what. But certainly if you look at the valuation of stocks and you plot the valuation of stocks versus inflation, the sweet spot is 2%. Because it's far enough away from deflation not to scare people, but it's not high enough to erode the value of money hugely over a reasonable period of time. Oh, that's kind. C Mark says, hope your cold is abating. That's very kind of you. Yes, it's a lot better than it was even yesterday. So that's good news. It's funny, I went to the vegetable shop around the corner, Nathan's in Holmer Green today, and they actually said, where have you been? I think I've hit their revenue really hard because I usually go in there every day with Teddy. I make a fuss of Teddy, we buy some vegetables, some fruit, have a chat, but I wasn't there for, must be about 5 or 6 days now. I've been housebound. It's been dreadful. Really bad cold. Not COVID, because we did test for it, but really grim. There must be something going around. Why should one hold a small holding of Bitcoin, e.g. no more than 1% of net worth, as diversity and growth play? You can do, but personally, I'm not holding Bitcoin at the moment. I did play around with it when people were still interested in it, but I haven't really gone back to it. I don't think that a non-income generating asset is valuable. You can't value it, and for me that always makes me nervous. The same's true of gold. Very difficult to value, but yeah, what is the fundamental value of something that generates no income? Difficult to know. Ensol says, why not 5% or 10%? I guess you're talking about the inflation target. Yeah, you say yourself, Ensol, it's the economic sweet spot. Yeah, what people are really scared of is deflation, because if prices are falling, you can enter this downward spiral where people delay purchases. So if your car is currently going to cost you, £20,000, by delaying the purchase, it's going to cost less in a year's time. Well, it would make absolute sense to defer all your purchases. But then you enter this kind of downward spiral for prices, and that can destroy profits for companies. And it's just a terrible situation. So deflation is what people are really scared of, and of course very high inflation as well. So that is kind of the sweet spot. Yeah, I didn't do anything on the ECB. I always assume that people aren't interested in the ECB. So I didn't even listen to what the ECB had to say. I should have done, but I didn't. So I've got no opinion on the ECB at all because I haven't really been following it. But yeah, maybe we should do an ECB one as well. It's just, I have 2 back-to-back nights. So you have the Fed and then I have the Bank of England. And that pretty much takes it out of me. But yeah, maybe we should do the ECB as well. And JW says, well, the good thing is holding rates longer than US, or even implying they will strengthen sterling. Yeah, a stronger sterling will actually help reduce imported inflation. That's true. So pass-through inflation will be smaller as a result, which is good news. The bad news, of course, is that our exports are less competitive. But at least energy costs come down when sterling strengthens. So that would be potentially a good thing, given the importance of energy prices in the UK. And of course, it is an input cost for most of the companies in the UK. What else have we got? Do we have any super chats? No. Do we have any supporters asking questions? No. Okay. Record 12 says Superman movies were good. Not sure how that got into the conversation. Yep, next inflation print's going to be 18th of December, so that's in 4 days' time. You said we need a recession, i.e. unemployment. In history, all inflation spikes end with recessions. Yeah, that's the unfortunate truth. This is from Robert Huggett, which is that usually the way to really convincingly get rid of inflation is a period of recession. Usually what happens is the central bank hiking rates triggers in a period of high unemployment and a recession, which is pretty much the same thing. But that doesn't seem to have happened in the US, certainly. But in the UK, I think it's more likely. So we may actually already be in recession. We won't know, of course, because you find out with a delay. But yeah, I think we might already be there. Simon Shott, long two treats. Yes, you were. And Alex M thinks that's a splendid shirt. Yes, a man of good taste. Has the Greenland flag on it. Okay. Luca Parker says, earns just rebalanced. How long does it take for the money to go into my trading 212? To be honest, I don't know how long it'll take. My guess would be less than a week. But earns, by the way, if you don't know, it's a money market fund, an income version of one. So it pays out, I think, monthly. Let's have a look at earns. What's the payment frequency? Fund facts. Distribution frequency, semi-annual. Okay, so that's a big deal. It only pays out every 6 months. That's an awful design for a money market fund. But yeah, it should pay out soon, I guess. Okay, the interesting question from Abby Drysdale, who says, how likely do you think it is we have a smooth rundown in bond yields and mortgage interest rates from here? Thank you. Well, let's have a look at those. Let's have a look at the yields, at least gilt yields for the UK. Let me just get my dashboard. I'll get the trackers. Yeah, so this is one of the. Let me share this so you can see what I'm talking about. Okay, so these are the trackers that we have for our members. And for the macroeconomic stuff, we've got all sorts of goodies. We've got things like a table of gilts, so you can see which gilts are available to buy, and they're sorted by their maturity date, and then you can click on a button and get the fire up Wolfram Alpha bond yield calculator. It fills everything in so that you can get the yield to maturity. But let's go back. And we'll go back to the trackers, and what we'll do is we'll have a look at the gilt yields over time. So how have they changed over time? And this is the 5-year, 10-year and 20-year gilt yields, and this is data from the Bank of England. You can see they've increased a huge amount. So the question you're asking, I guess, is this going to be a smooth ride down to normal levels? The thing is, what's happened right now is we went from a curve which was like steep, you know, the 20-year was higher than the 5-year, to one in which it's kind of high and flat. So it went from that down here to that. So what I expect to happen is once inflation starts to fall, the long end will probably stay pretty much where it is now, and the short end will move down as it prices in the short, as it prices in bank rate falling. And so we'll end up with the curve which is kind of more normal, 5%ish at the long end, 2%ish, 3%ish at the short end. But how smooth that'll be, who knows? I think there'll be lots of hiccups along the way, actually. Things like elections, I think that's likely to cause a bit of a hiccup in yields. The budget in April, in spring, we don't know exactly when. I think that'll probably be another hiccup. But certainly the yield curve now, if you look at it, is kind of weird shape, but it's still worthwhile buying money market funds because those are generating the highest rate of return, currently about 5.2%, and that's because they basically feed off the very short end of the curve. Whereas if you increase the duration of your bonds very rapidly, that results in a fall in yield. So the term premium's negative because of the inversion of the yield curve. So I think at the moment it's still not really worth taking duration risk in the UK unless you're really bullish on yields falling. And I'm not that confident that's going to happen. So is it going to be a smooth ride? I doubt it. I don't think so. Am I sharing the screen? Yes, I am. Good. Can I unshare? That's a big question. I don't think I can. If I minimize everything, then I have a chance of doing it. There we go. So back to your questions. Do we have any super chats? No. Do we have any members asking questions? No. Okay, one more question then, and we'll draw a line under it. My voice has lasted. Well, that's interesting. After Damien, will you also invite Vicky? Who's Vicky? Is that a YouTuber? Vicky Finance YouTube. Vicky the investor. Is that who you mean? Or Vicky Robin? Victoria in finance? Maybe? I'm not sure who you mean. I actually haven't heard of her. But yeah, I'd consider it. Tritax Big Box has had a really good 3 weeks. Yes, I've noticed that as well. So has Scottish Mortgage. That's finally in the green for me, which is good news. Not so much for Tritax even after the rally, but still, let's have a bit of faith that things are going to start to recover from here on. Anyway, look, thank you all for joining us. I hope that was helpful. I hope the kind of summary of the macroeconomic stuff helped, because that's essentially what drives the Bank of England's decisions. But I think so far, at least, this sticky core inflation hasn't been solved. And I think until we get wage growth starting to slow down, I think that service prices, the price of services, is going to carry on being high. The rate of growth is going to carry on being high. But I think we are going to have to go through some pain. It's not going to be like the Fed, where it's a safe land, where it's no recession, so we get a fall in inflation without having a very high increase in unemployment. Soft landing was the word I was looking for. So I think in the UK we've already kind of hit the ground, and we're kind of just dragging along the ground and not able to stop. Anyway, look, thank you all for joining us. Don't forget to like and share, and do subscribe. And don't forget our live stream with Damo is next Tuesday at 2 p.m. So thank you all for joining us. Take care and good luck with your investments.